his internet cut off. So he still managed to do the call with his cell phone. So it's pretty amazing.
There we go.
Yeah, I am on my cell phone's mobile hotspot right now, so hopefully we will avoid any more internet issues because I've certainly already had my fill today.
Well, Steve, the virtual stage is yours. Go ahead, start the session. Once again, thank you so much, and guys, thank you so much for the patience. And let's.
Thank you, Manny.
Let's do it. Yep.
All right. Well, let's jump right into it then. So as I said, we're going to be looking at the state of the LA apartment market today. And this data is coming from all the different places that CoStar gathers information, in-person research, our listing sites like apartments.com and sister sites. All of that kind of coalesces up to this wider picture here. So we're going to start with this overview of the LA market. We're talking about LA County when we talk about the LA market here. And we're talking about market rate units only. So affordable, senior, student, those kind of things are excluded from this data with market rate units only. This is a supply, demand, and vacancy chart. The supply here, your blue bars, are just how many new units were delivered in a given quarter, right? And each of these sort of pairs is a quarter. So your blue bars are just how many new apartment units, market rate apartments units were built. The flip side of that is demand, yellow, and that's a measure of absorption or leasing, just how many more units were occupied or vacated relevant to the previous quarter. So the relationship between those two is what determines our vacancy rate, which is the green line here. So anytime you've got more new supply coming online than you have demand, your vacancy rate is going to trend upward. Anytime you have more demand than you do new supply hitting the market, your vacancy rate is going to trend downward, right? So you can see for most of the last decade, LA was a very, very tight market. As a county, around 4% vacancies, one of the lowest rates for any major metro in the entire country. We did start to see in 2019 just a slight uptick in vacancy. And really, at least in the early part of the year, that was more about a heavy pace of new deliveries. We had a lot of new construction coming online at the end of 2018, 2019. So even though demand was pretty strong from a historical standpoint, it wasn't enough to keep up with all this new construction. That's why you see vacancies start to trend upward. But then even before the COVID outbreak, COVID really hit in the second quarter of 2020, which is this big negative absorption chunk here, negative bar. But you can see we had a couple quarters, soft quarters before that with a lot of new units delivering and fewer units occupied than were occupied the previous quarter. So already kind of trending in the wrong direction, and the COVID-19 outbreak just seemed to sort of accelerate that trend. A lot of reasons for that. Primarily, job growth in LA was slowing, and perhaps most importantly, the population was declining slightly. LA's gotten so unaffordable over the past 10 years or so, 10, 20 years, that you have a lot of lower income households leaving the area for more affordable places like the Inland Empire or Las Vegas or Phoenix. As a result, LA's population declined, just very slightly by less than 1%. But obviously, when you have fewer people there, that equates to less demand for housing. So that's why you see, vacancy starting to trend upward even before the outbreak. Then bam, COVID hits, and vacancies over the past couple months and quarters have shot up to above 6%. So for some perspective, 6% vacancies is the highest we have ever tracked in Los Angeles. It's an all-time high, but it is still lower than the national US average vacancy rate, which is around 6.97% today. So we are at a soft spot, definitely a weak spot for the LA apartment market, but we were starting from such a tight market that even several quarters of some of the softest demand we've ever seen, really, we're still, kind of ahead of the national average here. And then you can see in the past couple of quarters that there have been some signs of life, that demand has turned positive again. And at the end of 2020, in our fourth quarter, leasing was largely in line with what we saw in earlier quarters, pre-pandemic. Now, our vacancy rate's still trending upward because we still got a lot of new projects delivering. It takes 2 to 3 years to build a new apartment building, especially a larger one in LA. So all this stuff got off the ground in 2017, 2018, when we had super low vacancies, right, is now hitting the market in a much different leasing environment. So that's why vacancies are trending upward, even though demand seems to be stabilizing a little To look at this another way, that green line before was vacancy. So that's just physical occupancy, right? How many units actually have someone in it. To look at it a little bit different way here, this is availability. So this is more marketing based on our apartments.com and our network of listing sites and the apartments that we call of the units in your building, how many are being marketed as available. And you can see we call this a stabilized availability rate. And what we're doing here, you remember back in this previous slide, I talked about how new construction is really driving the vacancy rate upward, right? A new building hits, most of its units are vacant, so that's a lot of new vacant units added to the market that'll bump up the vacancy rate. The stabilized rate tries to control for that by just weeding out new construction, stuff that hasn't stabilized, hasn't hit 90% occupancy yet, or is less than 19 or 18 months old. So when you take out those properties, the overall picture looks even more encouraging, with a stabilized availability rate around 4 or 5%. That's perfectly healthy, up a little bit from where we enjoyed the past couple years. But I think the overall message here is that while we're definitely seeing some weakness in the market, the sky is by no means falling, and that LA is still structurally a pretty tight market, that even these major disruptions haven't really blown our vacancies and availabilities out of the water yet. However, this green line here is for all of LA County. That covers a lot of area, a lot of real estate. And when you start breaking that down a little bit, some interesting trends kind of emerge. So we can look at this geographically, right? Looking at the performance of urban versus suburban areas. CoStar tracks sub-markets, so smaller regions within the LA market. And this is looking at the performance of urban versus suburban submarkets. So what do we mean by urban versus suburban? This is a screenshot right out of the CoStar product with the urban location filter selected. Each of these little dots is an individual multifamily property that CoStar tracks. Just gives you an idea of how much data we're pulling from here. So when we're looking at urban, we're essentially looking at Central and South LA and Woodland Hills and Long Beach, where our suburban communities, San Gabriel Valley, Santa Clarita Valley, Antelope Valley, and San Fernando Valley. So just to kind of square ourselves here. So when you look at the availability rates broken down by location, there's some pretty clear divergence here between the two, right? Overall suburban availabilities are down around 3%. That's essentially close to fully leased, right? There's always going to be a little bit of vacancy baked in as leases expire. So that's 97% occupancy in suburban communities in LA. The flip side of that, in our urban areas, excuse me just a second, I want to admit someone who's joining. The flip side of that in our urban areas is that the availability rate spiked at the start of 2020, or when the pandemic broke out, and really has, while it's trended downward, things are much softer in your central city and urban areas than they are in the suburbs. And this makes sense for a couple of reasons, right? You've got renters looking for affordability, either because they've lost their job or they're just looking to minimize risk. You have a lot of renters who used to be tied to these urban areas because that's where their jobs are, but they haven't been into those jobs for 9 to 10 months at this point, right? So does it make sense to keep paying Santa Monica rents or West Side rents when you're not commuting to your job in Santa Monica? For some people, the answer is yes, for the lifestyle. But for a lot of people, especially who are trying to minimize risk and trying to control costs right now, you can move from downtown or the West Side or Central LA out to the suburbs and find more space for less money. And if you've been working from the kitchen table or from the couch for the past year, that's a pretty compelling value proposition when you don't need to commute to your job in these urban areas anymore. That's one of the things that's really driving this divergence here. So how are these trends kind of playing out at a rent level? Again, we're comparing LA County as a whole here to the United States, LA in red. And you can see, for most of the last decade, and most of the last expansion, LA really pretty dramatically performed the United States. Rents often growing by 1.5% to 2% more over a course of a given year than they were in the nation at large. And that's one of the reasons that LA has been such a dynamic market over the past decade, such a popular target for investors, is this strong rent growth. And that really comes from those low vacancies and low availabilities that we saw. The picture, just as we saw in the vacancy space and kind of the space, supply and demand picture, started to shift even before the pandemic, though. We saw this slowing growth in 2019 for the first time, not besting the national average, first time in 7 or 8 years. And that's tied to those other trends that we already looked at, the rising vacancies and slowing population decline, things like that. So overall, this year, the pandemic accelerates that trend, whereas nationally, rates essentially stagnated, no growth, but stayed put. Overall rates in Los Angeles fell by about 2%. So not good, obviously, but if you compare it to what we saw during the last downturn, during the great financial crisis, when rents fell by almost 7.5%, it could be a lot worse, right? Nobody wants to see rent losses, but we've also avoided sort of the bottom falling out of the market like it did back in 2009. Where are we now in this overall rent growth picture? You can see that generally the forecast and the anticipation here is that we might see a bit more losses in the first quarter here, but generally that the worst of it is behind us. That we anticipate that for the most part, rents will slow their kind of steady downturn that they've been on for most of this year. We don't anticipate seeing a lot of growth in 2021. It's going to be more of a stabilization or a stagnation. But then our models anticipate a real jump once the economy gets going again. Now, this is predicated on an assumption that the vaccine rollout goes smoothly this year, that the economy really starts to get back to more or less something approaching normality by the end of the year. If that is the case, then you'll have a lot of pent-up demand. You'll have a lot of people who are looking to come back near their jobs if they need to. You'll have a lot of people who maybe were doubling up or tripling up with roommates, now looking to get a place of their own, or living with mom and dad, now looking to move out. So there's a potential for some pretty strong growth during the recovery here, if the economic growth and jobs projections kind of hold up as they do, in line with some of our best years of the last cycles. Now, again, though, we've been looking at county level numbers, and when you start digging into it a little bit more, there are some clear winners and losers emerging. So we're taking a look here at 1-bedroom rent trends in Los Angeles versus the United States as a whole. We're limiting this to properties with at least 50 units. And that's essentially because we get a lot more data from those properties. They tend to either feed us their availability information on a daily basis, or we call them on a monthly basis. So it makes for a very good data set when we're collecting the same information from the same property, day after day, month after month. This is an index chart. So essentially the level that rents were at on January 1st is 100 in this chart. And as you go down, once you get to 99, that's essentially a 1% loss, 2% loss, 3% loss. So if you're not familiar with index charts, that's just what we're looking at here. So you can see that we followed some similar trend lines here, that sharp losses at the outset of the pandemic. Things stabilize a little bit during the summer leasing months, and then slowly start to trend downward again as we enter the winter and the new year. Really, the divergence here is kind of in the early months, the early months of the outbreak. The losses in LA were a lot more pronounced, a lot sharper than what we saw in the nation as a whole. So at the end of the year here, you can see that LA is definitely underperformed compared to the nation as a whole. But it's not all of LA that's underperforming. Remember, we've got this urban-suburban divide emerging in rent growth, in the vacancy picture, the vacancy and availability, and that's really driving very differing fortunes in the rental space. In our outlying areas in San Fernando and San Gabriel Valley and points north, rent levels are actually above where they were pre-pandemic. And that's because, just think back to that 3% availability rate that we saw in suburban neighborhoods, right? That will drive some rent growth even during an economic downturn. The flip side of that, in our urban properties where we seen availability spike, rents are down sharply in these 1-bedroom units over the course of this year, down nearly 7%. That's very, very, very dramatic rent loss there, and really speaks to all these trends that we've identified, right? A flight to affordability. And also, during this era of social distancing, a lot of people just don't want to be in these dense downtown communities where you're you're riding the elevator up with a bunch of people and in the hallway with a bunch of people. If you go out to the suburbs, that's going to offer the perception of safety for people and a little not quite as a shoulder-to-shoulder lifestyle here. So again, this urban-suburban divide emerging, and the same, these same ideas that we're talking about, a move away from these pricey urban areas out to the suburban areas where you can get more space, also shows up when you look at rent trends by unit type. So breaking down by size here, probably no surprise if we've been watching everything we've seen today. Studio bedrooms faring the worst, and that just makes sense. If you've been, the studio bedrooms, which were built in abundance in places like downtown and Hollywood last cycle, there's not a lot in your actual unit there, right? You're paying top dollar for the amenities in the building, your gym and your pool and your rooftop gathering area, and everything that the neighborhood has to offer, right? The bars and restaurants and museums and clubs and social and cultural events. Well, in this era of social distancing, all of those amenities and all of those businesses and everything that makes urban living so appealing, most of that has gone away. And now you're just stuck in your studio apartment trying to get work done, and you don't have any room to stretch out, or you're feeling like your studio starts to feel like a prison a little bit, right? So that type of unit's falling out of favor during the pandemic. We see studio rents down around 5 to 6%, one bedroom rents, similar performance. And then basically the larger the unit, the better it's doing. 2 bedrooms up, slight losses, but nowhere like what we're seeing in the studio space. And again, these 1 bedroom or 3 bedroom plus, more or less where they were at the start of the year. So pretty clear winners and losers emerging here in this move toward less expensive areas where you can get more bang for your buck, more space. That will become very evident in this sort of ranking of the submarkets that we track when you're looking at winners and losers here. Strongest rent growth in all of Los Angeles last year was up in the Antelope Valley in Lancaster and Palmdale. And that's not because everybody decided that the Mojave Desert was the place to be. It's because rents in Antelope Valley are $1,000 cheaper, than the LA average. So if you're being priced out of Central or LA, but you still want to be close to your job or your family, Antelope Valley is one of those last bastions of affordability. We're seeing similar thing going on in the Inland Empire to the east. The Inland Empire has been one of the best performing markets in the entire country during this slowdown, because all this demand and that LA has lost, and all these renters that are moving out of LA, a lot of them are going to the Inland Empire where you can still be close by, but pay a lot less money. So similar trend playing down, throughout our winters here. You see the word valley over and over and over again, down and even into South and Southeast LA, which are typically pretty slow growth areas. And then the flip side of that, our premier submarkets, the sexy zip codes, those are the ones that have really seen sharp rent losses over the past year. Downtown, Venice Beach, Santa Monica, Hollywood, Burbank, right? This is just a who's who of where the job hubs are. And prior to the outbreak, typically this is where the renters want to be. Although there's, these units are very, very pricey. It costs a lot to live near the jobs in Los Angeles. These are also the areas, some of the only areas that have gotten a lot of new development. Downtown, Hollywood, Culver City, there's been a lot of new construction in these areas. So you think back to our talk about stabilized availability and the impact of new construction hitting the market. These are the areas that also feel that supply risk and that competition from new units opening, so kind of exacerbates the losses and the challenges that these areas were already seeing. One more impact of that we can see here, one more is in the use of concessions that really shows the impact of the pandemic here. At the start of the year, only about 1 in 10 properties of more than 25 units in LA was offering some sort of concession, either free rent or gift cards or free parking or something along those lines. And just about everyone that was offering that was a new property that was still in lease up. Those are typically the only areas in LA where renters could get any concessions, because you'll recall when you're at 3 to 4% vacancy overall, there's just not much need for landlords to offer any sweeteners to renters. The picture definitely changed this year, and by the end of the year, almost half of the communities in LA were offering some sort of concession to keep renters in place. So that may be another reason why we've seen the market hold up relatively well, why we haven't seen a massive vacancy explosion, and why we saw apartment demand really start to creep back over the second half of the year is the pot has been sweetened for renters, right? If you can get a month of free rent, or in a downtown or Hollywood, a place with a lot of new construction, you're looking at 2 months free rent, maybe more. That suddenly starts to change the underlying calculus for a renter quite a bit when you can shave a month or two off of your yearly rent costs here. And as you might expect, if you've been following along to this point, the picture's remarkably different in suburban areas versus, this is not all of our urban areas, this is just downtown LA. So downtown LA, nearly 70% of properties are offering some form of concession to get renters in the door. Out in the suburbs, really just a very slight increase from the start of the year. Really not much use for it with availabilities down around 3% in the suburbs there. So I know I've thrown a lot of charts and graphs at you guys. I appreciate you sticking with me through now. We'll wrap up with a quick look at the investment scene, and then we'll be done today. So this is a look at just investment volume, how many dollars are being spent on Los Angeles area apartment assets. And I did see a hand raised there. Feel free to go ahead and unmute yourself if you had a question that you wanted to interject.
So
Yes.
Hi, this is Sam. So my question is, all these charts are based on organic event taking place, meaning that, you know, the landlords are giving free rents and there is forbearance, there is this, there is that. If none of that would be in place, do you have anything that you can say what would happen to the market if there was no help from the government, from the landlords, from basically, because I don't think that this is gonna last. You know, I don't know how long more can the banks hold off? How long more the landlords can hold off on, you know, receiving rents?
Mm-hmm.
So the question is, if that all goes away, what would happen to the market? Is there anything that can describe that market?
Yeah,
Like more organic. You know what I mean?
absolutely. Yeah, that's a great question. The short answer is that really in our forward-looking projections, we don't take into account the eviction moratorium and the forbearance and things of that nature. We're essentially looking at job growth projections and population growth projections coupled with historical data here. So anything forward-looking we talked about today is kind of independent of all that other stuff. But you were right that when I talk about, you know, a very low availability rate, for you just jump back here, that a big part of that may be because right now landlords can't evict any of their tenants, right?
Exactly.
So there's nothing hitting the market. And the short answer really is no. It's tough to account for that. You know, typically when prior to the pandemic, when we do forecasting and look at the apartment market, we're just looking at, you know, vacancies and rents and job growth and none of this outside stuff like, you know, the eviction moratoriums and all the other legal and regulatory things that have come in. So it makes, you know, forecasting even in normal times is at best a attempt to predict the future sort of based on historical performance. In a historically unprecedented period, forecasting becomes even more challenging. And when you mix in all these public health and regulatory environments, no, it becomes a very confused situation. So it's a great question and something definitely worth keeping in mind when we talk about, you know, the overall strength of the market and the availability rate and vacancy rate. But, you know, when we look at our forward-looking projections based on job growth and things like that, we see strong apartment demand, that the things that have limited and suppressed apartment demand during the pandemic are temporary rather than structural, and that a lot of the long-term appeal of Los Angeles and the things that make this such a compelling apartment market for developers, investors, are still going to be there in the long term when things return to normal. Short term, I think expecting some, especially, you know, when things like the eviction moratorium and is lifted, that could cause some short-term chaos. But it's very difficult to predict what that would look like, right? I think the incoming administration is planning to extend that even longer. So trying to, put a dot on the chart and a number on it and say this is going to be the impact would probably be giving a false sense of confidence or clarity. But it's a very good question and a great point to raise that some of the stability that we've seen today may be artificial because of all the, the moratoriums and other things that are in place right now. One thing that doesn't get affected by this artificial, things like moratoriums and control is investor sentiment, right? That's just going to reflect what investors are seeing when they're looking at the market. So this chart looks at quarterly transaction volume in Los Angeles. How many dollars are being spent on LA assets? In 2018 and 2019, more than $11 billion in total multifamily sales were recorded in LA County. That led the entire country in both years. So clearly there's a lot to like here for investors. The supply constraints, the persistent demand, LA's large diversified economy, the name cachet and all of that really is a compelling thing to apartment investors, both big core investors and private investors alike. So you can see this year, unquestionably, there's been some impact from the pandemic, especially in that second quarter, which was the weakest that we had recorded in terms of sales since the last downturn. But you did see some signs of investors kind of dipping their toes back in the pools in the second half of the year. We're not back to the levels that we were prior to the pandemic, but this is not a flight for the hills either, right? We've got more than $1 billion in total deals recorded in the third and fourth quarter here. And when you look at these overall projections, you can see why. As I said, this is largely based on historical performance and job growth and to a lesser degree, population growth. So a lot of the extras that are floating out there aren't mixed in. But you can see what we're looking at here is just what our average price per unit is for apartments. This is across all LA, so from Beverly Hills up to the Antelope Valley. How pricing has gone up over the past decade or so. In 2011, we were under $200,000 a unit. Today, we are up close to $350,000 a unit. And if you look at just what happened this year, there's not much impact from the pandemic, or not evidence of a pullback in pricing, right? We saw some stagnation, whereas most of the previous decade had just been a period of steady growth. We did not get that this year, but we also did not see any kind of dramatic pricing declines or discounts on the sales that were taking place. And you can see that our projections here are that that in the long term, from the 30,000 foot view, I don't want to discount the troubles and the stresses that individual investors and renters and people and owners are going to feel. But in the long-term view, this looks like it's going to be largely a bump in the road if the job growth projections hold up. That we're going to see some slight pricing come down in 2021 and maybe another year or so of stagnation, and then largely back to business as usual in the outer years of the forecast here. So as Sam brought up, it's a very good point to take any kind of forward-looking projections right now with a pretty hefty grain of salt, because there's a lot of unknowns out there and a lot of stuff we need to account for that normally does not factor into the picture. But when you look at the long-term prospects for the LA apartment sector, we've still got this dramatic disconnect between how much we can build and how much people want to rent. The land cost, the construction cost, the regulatory environment, none of that is going away. It's still going to be difficult to build. So as long as the jobs come back and you see employers returning to these central city areas, the prospects seem pretty good for a recovery, maybe a year or so from now, and that will be back to largely business as usual by 2022 or so. So that was a lot to take in. I know. I'm happy to run through any questions and also throw up all my contact information here. So if you want to give me a ring or shoot me an email, we can keep the conversation going that way as well.
So I've got a question. Going back to the rents,
Yes.
So is there any sort of breakdown by building class, by asset class? Because I mean, my perception has been that sort of the D and C class properties have ridden, have done a little bit better than the A or B class.
Absolutely. And I'm not sure how many of you guys have access to CoStar. You can get in and see all that stuff really easily in there. But yes, the rough proxy here would be, think of your urban properties as kind of your class A and your suburban as kind of your BC class. That's a little too simple, a little too reductive. But when you're looking at performance, that's essentially how it's played out. Is the class A, the stress is in your class A properties, your high-end luxury stuff that was built last cycle, downtown or Hollywood or Culver City near the jobs, studios and one bedrooms, very high price per square foot. That is what's falling out of favor, and that's where the stress has been. The flip side of that, a lot of your B and C product is up in the valleys, right? San Gabriel, San Fernando, even up in C class up in the Antelope Valley, where we saw that real strong rent growth. That's the stuff that's in favor right now because it offers more space for less money. So those they are really outperforming. And most of the trends that we saw break down along urban suburban lines today, you'll see very similar trend lines breaking it down by top of the market and lower tier product.
Thanks, Steve. Good question, guys. What else? Other questions? Well, we have Steve on the call. That's a chance. Ask away.
I always say that either means we answered all the questions or everybody fell asleep. So hopefully it's door number one.
Yeah. Well, I don't think they fell asleep, but it was definitely a good content. Greg, any question?
No, I just want to say great information. Thank you for the presentation, and Manny, thank you for having me as a guest here today.
Yeah, thanks, Greg, and looking forward to have you next month as well as the speaker for sure. Appreciate it, Ricky.
Hey, Ryan, I'm sorry, Stephen, thank you so much for your time today and stepping in for Ryan last minute. And I just want to tell everyone in the group here, anyone that has any CoStar questions as well, I'm your account executive and I can help you. I do trainings all the time. They can be individual or we can set up like a group training. So just let me know if do you have any questions that I can help in any way. Thank you very much.
Sorry, Ricky, I just to add on to that, the majority of what we looked at today, you can find one way or the other in the CoStar product. So most of this information's out there ready for you if you want to dig into it.
Yeah.
Thanks.
Yeah, you'll find it in the analytics section under the home tab. So that's where most of it would be.
Thanks, Ricky. Yeah, and maybe it's worth maybe just to do like an overview. One of the meetings, kind of you can share screen and show a couple of quick links, how to do the sharing, etc. Sam, did you have another question?
No, I just know because you guys brought up a point that the AB class buildings are being affected the most now because of the prices, and probably the sizes too, because they're mostly micro units, the newer buildings. So if, let's say, if these landlords, they decide to lower their rents, obviously the tables will turn, right?
Well, they've been lowering rents, say downtown, rents are down 10% year over year. And it hasn't, I mean, we saw some signs of stabilization as we saw later in the year, but right now it seems to be more about these larger trends, safety and space than about that end of the day dollar per square foot, what I'm paying. That may change once the vaccine gets more widely, and life goes back to normal a little bit. But right now, the renter considerations seem to be going beyond, solely, what kind of fancy amenities are at my building.
I see. I mean, also, I don't think that this form of this type of Zoom meetings or working from home environment I don't think it's going away. It seems like it's here to stay. So I think that probably 2 bedrooms are the future. I mean, that's just my my prediction. So I think that the micro units are probably are not the future in the next probably 5 to 10 years. I could be wrong. And also we have a major exodus. I don't know if you guys know, if you go on uhaul.com, if you try to rent a U-Haul truck from Los Angeles to, for example, Phoenix, it will cost you $2,000. But from Phoenix to Los Angeles is $200. So
So you should fly to Phoenix, rent a car, and then just drive back and forth. It's going to be more affordable. Got you. Thanks for the tip.
No problem.
Any tips, go to Sam. Thanks, man. Appreciate it. What else, guys? Any other questions? Insight?
I just want to build on to what was just said. The way I mean, obviously we're all predicting the future here, so it's anybody's guess. But I think people are very reactionary and they have very, very short-term vision. So I think that all these trends that we're seeing now are just a knee-jerk reaction to what's going on. As soon as everything normalizes, I think we'll largely go back to normal life. People will start moving back to LA, stop moving out, and we'll see life turn back to normal.
If I had to guess, and again, it's with the caveat that all of this is just trying to read the tea leaves, is that you are largely correct there, Shaya. I wonder if in a downtown LA or a Culver City or a Burbank, if these major office employers decide to move to some sort of hybrid work from home, employees need to be in 2 or 3 days a week, so we can reduce our office, our square footage, our footprint by 20 or 25%. That will translate to reduce apartment demand. It's not going to cut the bottom out from under the market, but it may be that our peak levels in these job hubs prior to the pandemic are higher than what our peak levels are after the pandemic if these employers reduce their footprint somewhat.
Too, I chime in here too. Let's not forget about what happened in the 01 through 04, 05 in the residential market affordability hub, when everyone moved out to the Antelope Valley and moved out to the 91 and the 15 and got a taste of commuting from that distance to LA for affordability. Eventually they moved back because they just couldn't make that trek on a daily basis. So
we didn't have Zoom.
Yeah, but he's saying a percentage of those people that will have to go back will have to go back. They're not going to commute forever.
Yeah.
Especially not from the Antelope Valley. My goodness.
Mm-hmm. Good conversation, guys. Steve, anything else you wanna add?
I think I hit most of it. That was my second hour-long presentation today, so I'm probably going to be losing my voice pretty soon. So might be a good time to wrap up.
All right, much appreciated again, Steve. And you can drop the screen share.
Okay.
If you want, and I want to thank you again for just picking up the session last minute and sharing that information. Pleasure to have you, of course. And
yeah, thanks for the opportunity. And as I said, please just feel to reach out if I want to keep talking about any of this.
Great, thank you so much, Steve. Steve Basham with 𝐑𝐞𝐚𝐿. Anybody else? Anything else you guys want to throw out there? Want to bring up? Want to mention before we're gonna let you go? Okay, Ricky, thanks again. If you have any question, Ricky is the man. Is fast to respond and to connect and to assist. And once again, Ricky, thanks for all of your support. Appreciate it.
Of course. You're welcome, Manny. Thank you, everyone.
Thank you, Manny.
Thank you, guys.
Thank you, brother.
I'll make it rain. Thanks, everybody.